Today, we're going through the 5 biggest recorded stock market crashes in history, and more importantly, how you might be able to spot the next one before it happens. Because let's be honest, every crash feels unexpected in the moment, but when you look back, the warning signs were usually there the whole time. But before we get into those, an honorable mention goes to the most ridiculous crash in history, the tulip mania of the 1600s. Yes, actual flowers. In the Netherlands, tulips became insanely valuable. Prices skyrocketed to the point where a single bulb could cost more than a house. People were trading them like crazy, flipping contracts, getting rich overnight, until suddenly, demand disappeared. Prices collapsed almost instantly, and people lost everything. I mean, imagine having to tell your wife you lost your life savings on a flower. Now let's start with number 1. The famous 1929 crash called the Wall Street crash triggered the Great Depression. During the 1920s, the stock market was booming. Everyone was investing, often using borrowed money, but the market became massively overvalued. Then, panic hit. Investors rushed to sell, prices collapsed, and billions were wiped out in days. This crash didn't just hurt investors, it led to years of economic hardship worldwide. Number 2. Fast forward to 1987, or the Black Monday crash. In a single day, October 19th, the stock market dropped over 20%. One day. This was caused by a mix of factors: overvaluation, panic selling, and early computer trading systems that accelerated the crash. The scary part? No clear warning. It just happened fast. Number 3. Now we move into the internet era, and possibly the worst crash ever, called the dot-com bubble. In the late 1990s, anything related to the internet was exploding. Companies with no profits, and sometimes no real business, were valued at billions. Everyone thought tech stocks could only go up. Spoiler, they couldn't. When reality hit, the bubble burst, the market crashed, and trillions of dollars disappeared. Number 4. Then came 2008, the global financial crisis. This one was caused by a massive housing bubble in the United States. Banks were giving out risky loans, packaging them into complex financial products, and selling them as safe investments. When homeowners started defaulting, the entire system collapsed. Major financial institutions failed, markets crashed, and the global economy entered a deep recession. Number 5. Finally, one of the most recent ones was the COVID-19 crash in 2020. In early 2020, as the pandemic spread across the world, markets reacted instantly. Stocks plunged due to uncertainty, fear, and global shutdowns. But interestingly, this crash was also one of the fastest recoveries ever. So those were the 5 biggest crashes in history. Now the real question is, can we actually predict the next one? Let's go through some of the biggest warning signs that tend to show up before a crash, and how these bubbles usually burst. First, extreme hype and speculation. When everyone is talking about getting rich quickly, that's usually a bad sign. If people are investing in things they don't understand, just because prices keep going up, that's classic bubble behavior. Second, prices detached from reality. When stock prices keep rising, but the underlying companies aren't actually improving, that's a red flag. Eventually, reality catches up, and when it does, prices fall hard. Third, easy money and high debt. Many crashes are fueled by cheap credit. People borrow money to invest, which pushes prices even higher. But when things start going down, debt makes everything worse, because people are forced to sell. Fourth, sudden loss of confidence. Crashes often happen when sentiment flips. Everything seems fine, until suddenly it isn't. Once panic starts, it spreads fast, and selling becomes a chain reaction. Fifth, copper and industrial demand. Here's an interesting one. Copper is often called Dr. Copper because it's used in so many industries: construction, manufacturing, electronics. When the economy is strong, demand for copper is high. But when demand starts dropping, it can be an early signal that economic activity is slowing down. And that can sometimes happen before the stock market reacts. Sixth, rapid market growth in a short time. If the market shoots up very quickly in a short period, it's often not sustainable. Fast growth is usually followed by sharp corrections. So while you can't predict the exact moment a crash will happen, you can watch for the warning signs. Because history shows us one thing over and over again. Bubbles always feel different, but they end the same way. If you follow these signs, you just might be able to predict and avoid the next crash. And as always, this is not financial advice, but an educational video about stock markets and their volatility. If you enjoyed this video and want more content like this, make sure to subscribe and let me know what topic I should cover.